Cashflow Diary Podcast, episode 303.
Welcome to yet another exciting episode of the Cashflow Diary Podcast, the podcast that teaches you insider tips, tactics, and strategies for creating leverage streams of cash flow into your life. Learn from top-performing entrepreneurs, business owners, investors, and thought leaders from across the globe as they share their secrets to success. Like what you learn on this and other Cashflow Diary podcast episodes? Go to learninvestingnow.com and sign up to receive powerful tips and information that will help you succeed as an entrepreneur and investor. Now, here's your host, investor, entrepreneur, business owner, educator, speaker, author, and master facilitator of Robert Kiyosaki's cash flow game, Jay Massey.
All right, ladies and gentlemen, welcome to another episode of the Cashflow Diary Podcast. I'm your host, Jay Massey, and I'm glad that you're here today because one of the things that I know about you, because it's also true about me, is that where you start in this business isn't necessarily where you stay. Many of you know I started out as a wholesaler and we've done many different types of transactions, from multifamily to cell phone towers to commercial real estate, and now more recently, even delving into short-term rentals. But I started a long time ago in the world of paper assets, and that opened up my mind to many different things. Just remember, where you start isn't necessarily where you stay, but the good thing is you learn lots along the way, and today's guest has done exactly that. He's managed to go out there and start in something that doesn't even seem like it would make sense for what he's doing today, and I think you're going to love it because he's managed to go out there and become very, very successful. He's recently written a book. That's what I was trying to say. Recently written a book. Say that 3 times fast. Watch that rat hole and witness the REIT revolution. Now, some of you are like, what's an REIT? We're going to talk about that today because we have with us none other than Kenneth Campbell, and he has managed to go out there and build a firm that, hear the number, $20 billion in assets. So what does that mean? That means he knows exactly what he's doing. In fact, he literally wrote the book about it, and he's going to be able to help you and I understand the opportunity that could be staring right in front of us if we would but see it. So let's listen to Mr. Ken Campbell. Ken, you there?
Yes, I am, Jay. Good to see you.
Thanks for being here. I am glad that you're here. Where are you these days? Like, where in the world?
We are located in beautiful downtown Radnor, Pennsylvania. Garden spot of the world.
I like it. The garden spot of the world. So, okay, as this is your first time here, one of the things that I have to do is I've got to ask you the same question that I've asked all the entrepreneurs that have been here before. Are you ready?
Yes.
All right. So I tend to look at today's entrepreneurs a lot like yesterday's superheroes. So, you know, Batman, Robin, Superman, Wonder Woman, what have you. And I think entrepreneurs and superheroes have a ton of things in common. For example, we occasionally get dressed up and we fly around, or at least we think we're flying around, saving our customers and providing products and services and helping them with increase the quality of service to their lives. That's what we do. However, also like a superhero, you know, before Superman was before Spider-Man was ever, you know, slinging from buildings and doing his thing, he was just a reporter and taking, you know, photography. That looks like that was his thing. And I can relate to that. So what we want to know is, before all the things that you've done, before being able to write the book, before the firm that's managing billions upon billions of dollars of assets, before all of the degrees and everything that you've experienced, we want to know, who is Kenneth Campbell?
Well, that's a good question. I was born and reared in a steel town in western Pennsylvania near Pittsburgh. Today it has one of the only 1 or 2 active steel mills inside the state of Pennsylvania. The population of my hometown, Butler, has about halved what it was when I was a boy. So I have seen, you know, the ups and downs of the steel industry. I liked to write when I was in high school, and I was lucky to get under the tutelage of a debate coach, and she taught me how to debate, how to speak on my feet. And I will have to tell you, I tell everyone that I come in contact with, learn how to debate, because you'll learn how to speak extemporaneously, organize your thoughts, and keep on going in front of hostile audiences. And that was a life changer. I liked to write, and I took an English major in college. I went to a small school in Columbus, Ohio, called Capital University, and I worked up to 47 hours a week in a service station, which happened to be on the campus of that college. And one of my customers, believe it or not, was the editor of a local Scripps Howard newspaper called the Columbus Citizen. And so when I was about ready to graduate, I said, his name was Weaver. I said, Mr. Weaver, do you have any jobs open down at the Citizen? And he said, well, I don't know. Come on in and talk to the city editor. And I went in, and he said, what can you do? And I said, I write. And he said, well, prove it to me. Story. And so the university was right across the street from a city hall of one of the suburbs called Bexley, and they were building a new city hall. And that city hall had been under construction for what seemed like months and months and months. So I went and talked to the mayor and talked to the contractor and found out what was going on, and wrote a story, maybe 6 or 8 paragraphs long, and they printed it on the inside page. And lo and behold, I got a phone call to come in and work for as a newspaper reporter for the summer of 1951, and I've been trucking ever since.
I like it. I like it. No need for a job interview. Just show me what you can do. I like it.
No need for a job interview. Just show me what you can do. And so I caught on with the newspaper. I moved on to a magazine editor's job in New York in 1961, 10 years later. And that's an episode that I tell in some detail in the book, because it was a seminal episode in my life. And at my first job interview, the first news conference after I arrived in Manhattan, and here I am, green as grass, and sitting up there in a Manhattan skyscraper looking out over the East River, and the subject of real estate investment trust came up. The Congress had just approved the creation of real estate investment trust, and the city editor, managing editor, actually said to me, "What do you know about these things?" And I said, "I don't know anything." And he said, "Watch that rat hole," which was his journalistic way of saying, "That's your beat. That's your assignment. Anything that has to do with real estate investment trusts, bring it to me, and we'll see if we can get a story in the magazine."
Okay. Hold on. I got a question now. You said Congress had just passed and it was allowed to create the real estate investment. When was this?
They created it in September of 1960. Eisenhower had vetoed a previous bill that created REITs in 1956. So the fate of that bill was really uncertain, and Eisenhower signed it in 1960. And what it did, it would created a class of real estate investment organizations that would be managed professionally, and their shares would be sold to the public and traded on public markets. And the rationale was that this would provide individuals with the opportunity to invest in professionally managed real estate. Very, very much like a mutual fund. A mutual fund passes through all its income to its shareholders, and an REIT, must also pass 90% of its real estate income to its shareholders. So over the years, the REITs have the reputation of providing substantial dividend income to their shareholders, and over the years, about 2/3 of the income, the total return from REITs has derived from that income. So it's an income vehicle. However, in the last 20, 25 years, there's been a significant growth component added. So today, income is still important, but it's a little less prominent than it was back in the 60s and the 70s. But anyway, a real estate investment trust is simply a company that gets 75% of its income from rents or interest on mortgages. And so its income must be derived from the ownership of real estate. And it's very interesting, all these many years later, the Standard & Poor's has decided to carve out real estate as a separate what they call GICS. It's an index measurement. So if you go to the Standard & Poor's website, you'll see that starting in the middle of September, real estate will be an asset class, a separate asset class in the make up the Standard & Poor's 500. Probably going to be around 2.5% of the Standard & Poor's 500, but it's going to be a very, very significant event. So my life bridges, we don't know what these things are until they're now getting a really great recognition in the securities investment world.
Got it. Okay. So I've got a question. Since because it seems like there was some sort of controversy over the creation of REITs, if they were vetoed at the beginning, and now that they're in play, in September of 60, what was the general attitude towards a REIT at the time?
The general attitude was that that Eisenhower had used was that these are tax-paying entities, and therefore they should be taxable and not escape the federal income tax. And the counter argument was that they would add substantially to the general well-being of the country by bringing a much more organized management to real estate, and quite frankly, that has happened over a long period of time, 55 years now, I guess, and today the REITs are a little over a $1 trillion industry. There are about 175 REITs out there in the equity side, equity being REITs that own property, and then there are probably another 30 REITs that do mortgage lending in some other fashion. Some are commercial mortgages, and some are residential mortgages. And I just hasten to say that I got burned very badly with some mortgage REITs in the late 1980s, and I have never invested in a mortgage REIT since then. They are a very high yield. And many investors really love them, but don't ask me about them because I really don't follow them. I don't know much about them. I'm sorry about that.
That's okay. But here's what I do want to know. So how do we go from, this first article and to eventually having your own magazine, et cetera? How does that happen?
Well, okay, that's a good question. The magazine that I joined was sold, and I got a nice little severance pay. And I said, boy, I can invest in the stock market. For the first time in my life, I had enough money. And so over a period of 5 years, starting in 1964 through 69, I tripled my money. And I tell all the details down to $1 in the book, incidentally, so that people will not be mystified. And I convinced myself that I really knew how the housing business, which is where I had spent my time, was going to come public. There were a number of home builders came public at that time, that I could really be the world's greatest investment advisor in the housing business. And so my wife said to me, that's okay. I just put aside 1 year's salary so that I can put food on the table. And so I did that. And with my slimmed down stake, I started a newsletter on housing. Almost immediately, a category again called the Mortgage Real Estate Investment Trust started really getting hot on Wall Street. And believe it or not, within a year of founding the newsletter, I was finding 2/3 and 3/4 of my time was spent on the REITs. And so I started a separate newsletter on the REITs. I tell in the book how I labored and labored to get that first issue out there, and put it in the mail at 5 o'clock on one afternoon. And the New York City post office, postal employees went on strike at midnight. And I thought, oh my goodness, I had blown an obscene amount of my small stake, and they stayed on strike for 2 weeks. But the phone started ringing, and people said, "Ken, we know that this is going to be a good product, and so sign me up." And so I got very few, direct mail responses, but I got a lot of phone calls, and so that publication, which was originally called Realty Trust Review, became far and away our major revenue generator, and it caught much more interest than anything that I ever really did in the thing. And so I ran that newsletter for 20 years, and then I sold it in 1990. So it was almost by accident that I started off watching the REITs, and I watched them for the magazine, and then I got involved with the housing business, and then I came back to the REITs, and that's been my home since then. Nothing bad. When I sold the magazine, the newsletters in 1990, I was cast about to find some partners to start a money management operation. I was lucky to find 2 partners, Ritson Ferguson and Jerry Kling, and we started a company that now has pretty close to 100 employees and manages about $20 billion. So my life has been, and it's substantially all in real estate investment securities. It's a global firm. We have offices in London and Hong Kong and Tokyo and Sydney. So it's been an enormously rewarding life. And I just, I look at those 100 fellow employees and I say, boy, that's my business family. We just love every one of them.
Got it. Now, I've got a question for you because I think you're going to have a very interesting perspective on this. What would you say to the individual or individuals who think that, that success or their business is supposed to quote unquote happen overnight or quickly and all these other things? What would you say to that particular individual or someone who might think that, oh man, it hasn't happened for me yet?
Well,
go ahead.
I just say it doesn't happen that way. Number one, you mentioned quality of product. We just always tried to put out the best doggone product we had that we could figure and lay it all out there for our subscribers because they were, providing the money. And I think that they liked it. Generally, we had some disagreements on a couple of issues on disclosure and accounting with some of the subscribers over the years, but we just felt we had to be very true to ourselves. We published, as I say, I had the housing newsletter and the REIT newsletter. So we published a weekly newsletter every week. So something was going out of our shop every week to a list of subscribers. The REIT subscribers were much bigger than the housing newsletter, but I had come from the housing business, and the housing business was still good to me, and I knew a lot of people there. So I kept that business going. And then in 1990, a thing called the fax machine was coming in. And the business of a paper newsletter started to be very, very difficult. And I didn't really want to make the capital investment on switching from a printed piece of paper to a digital function. So I sold it to a chap, and he sold it to another chap, and that chap still maintains it as a very, very vigorous email newsletter. It's still there today. It's not got the same name because he's put his own stamp on it, but he operates out of Northern California, and he does an excellent job. Keeps everybody really hopping.
Nice. Well, since you bring up technology in terms of the fax machine, I'm going to ask a couple of questions. I'm actually asking in one sentence. I'm going to ask 3 questions because I'm kind of curious as your perspective as to how these 3 things in particular affect either REITs and real estate and just the markets today. So we've got, and you can take them in any order. We've got the idea of crowdfunding. We've got the idea of the sharing economy with things like Airbnb. And then we also have Brexit. So you can take those in any order you'd like, but I would love to hear your thoughts on how any one of those 3 things affect everything as we know it today. One of the greatest things about, history is that it kind of repeats itself. And you probably are picking up on that. And what's really cool is that there's a resource that we can all tap into to find out what might happen in the future by examining the past. And there are some people that lived it. And I don't know about you guys, but what it comes down to is oftentimes every time we go out there to be an entrepreneur, we're trying to predict and make the future. One of the best ways, if you are ever concerned about making a mistake and you want to know what not to do, I think one of the best ways that you can avoid a lot of those mistakes is to go out there and gather someone else's experience. Speaking of experience, feel free to pick up a copy of Cashflow Diary, the book. Cashflow Diary, 10 Steps to Creating Wealth in Any Economy. All you got to do is go to cashflowdiary.com/free book. Again, that's cashflowdiary.com/free book. Now, let's find out what he knows.
Let me start with Brexit because it's the one I think I know the most about. Brexit, I think, is going to decrease demand for office space in London for the next couple of years, and that's not a bad thing. London, if you look at the vacancy statistics, you'll see that London had come from a relatively high, and I'm going to say in the 10% range, vacancy in their office buildings, both in the city and then the East End, which is over toward the Palace and Hyde Park, and that occupancy had been trending down fairly dramatically, and our London office had said that we're going to be a number of new buildings built because things were getting tight. I think that the Brexit is going to mean that investors are probably going to postpone or maybe even scrub some of their projects. And therefore, I think it's going to be good from the landlord's perspective in London. However, I do think that some of that money is going to come to the United States, primarily to London or to New York. And New York is going to be a much, much stronger global financial capital. London and New York had been sort of duking it out in my mind, and I think this is big help to New York, and we're happy because there are a number of REITs that are very substantial landlords. About 20% of the office space in New York is owned by REITs right now, and I think that probably will move up a tad as we go forward in the next 5 years. But the thing I sort of see is that it's probably going to be good long term for Great Britain to be more on its own. But I think it will be some really transition for that country and its real estate companies. The UK had legalized the REIT status about maybe 10 years ago now. And I should say that there are about 3 dozen countries around the world that have now legalized the REIT status. So it's a very big thing internationally. The United States is only about 40% of the total REIT universe anymore. So Brexit will have some impact. And it will, I think, slow things down a little bit. It probably will help Frankfurt, which is, I think, sort of the major financial capital of the continent, and that's probably going to be good for Germany. And somehow I don't see Paris as coming quite as strong, but sometimes these things are really hard to see in the early aftermath of a. Yeah, crowdfunding is a very interesting topic. Interestingly enough, at my church, I have a chap who has trying to start a technology game. That's the best I can tell you. I don't know any more about it. And he's relying on crowdfunding. And I know it's out there. And I know a lot of people are relying upon it to raise capital. And I think it's an extraordinarily good development in the capital markets. People tend to think or forget that Google, when it came public, tried to underwrite its own stock offering because it didn't want to pay the relatively high commissions in the 5 to 6% range that the Wall Street underwriters were demanding. And as I remember, the stock came public around $85, and now it's what, 500, 600, somewhere in that range. So it's been an enormously successful. So there entrepreneurs out there are very, very, very sensitive to the cost of capital. And crowdfunding, to my way of thinking or looking at it, not a heck of a lot of research into this, does give an entrepreneur the opportunity to make his case to an investor group that will come in without asking an arm and a leg or role. And so I think that crowdfunding is probably going to grow and grow and grow. It just seems to me it makes a lot of sense. And as you would know, real estate business is driven by capital. And so far as I know, there is no real estate crowdfunding site or organization out there yet. But if I were young, I would certainly look at the opportunities there, because I think crowdfunding has a substantial impact on the potential to change the entrepreneurial direction. The United States has been, I think, the biggest and best proponent of creativity and entrepreneurial drive. I think our IPO record is like 3 times that of Europe, and we need new ideas to come along. The third idea, and this is, the sharing concept in the we tend to think of that as sharing apartments and sharing automobiles, Uber and Lyft, and on and on and on. But I tend to think that the sharing of space is probably going to be a much more dramatically impactful thing on down the road. Obviously, Uber has some, and Lyft have some impact. I read today an article that one of the very large REITs called Equity Residential, which interesting enough is controlled by Sam Zell.
Right.
Chairman of it, that they work with Uber at their locations to have Uber cars almost at the beck and call of their tenants, because they see that as a way to make more services to their tenants, make it easier and happier for the tenant to get a ride, and they don't have to own a car. So I think that's a very substantial thing that's out there. The name that was coming to my mind is WeWork. There have been, back since the 1970s and 80s, there have been these office sharing companies. I think the biggest one that I'm aware of is
Regis.
Is based in London, and they've been very successful around the world. But what we're seeing is that WeWork has come along. They have several locations in New York, which are absolutely blow your mind, because they have little 600 square foot places that a guy or 2 guys can sit and work on their computers and develop new ideas on how to do things. And so we work, and then another REIT called Varnado Realty has started doing I think they just opened it within the 30 days, called We Live, which is an offshoot of the WeWork in Washington, D.C. And they were talking on their conference call about a week ago that the rental was just out of sight. I think they rented 42 or 45% of the spaces that they put on the market within a month or 2 months. It's just amazing. So I think that I'm enthusiastic about these sharing of resources, because I think we're getting to be into a world where we need to make more efficient use of all of our resources. And it just seems to me that the sharing business is one that I could get really excited about. So if I were young, and I'm not, I would certainly be enthusiastic at looking at all of those opportunities.
Well, and you're hitting on exactly where I was headed with this question. Is I'm wondering how similar do these things look to you, where when REITs were just first getting started. There seems to be a parallel to me as I listen to you.
There is. The REITs, when I started in the business, whenever my boss said, "What's that rat hole?" The business of real estate finance was very, very much a patchwork. I say in the book that it was really almost always a country club kind of funding, where a developer would join a country club, and he would pass around his brochures to his friends at the country club, and they would put their money into a thing, and then they would lever it. As far as they could with a bank, borrow 80-90% of the money, and get up and running. It could have a big office building or industrial building or whatever. So that was the way. The REIT business essentially began flourishing when the REIT executives said, we will limit our debt leverage to 50% of the value of the property portfolio, and they have very well maintained that. There are a couple of exceptions along the road, but today, instead of 75 to 90% leverage in the real estate business, you see around 50%. Actually, the average is more like 40% in the REIT industry. And I think this has given real estate a stability, and that's why the REITs have grown, because they've proved that they're a stable source of income, but they're also a stable source of longer term growth. And so I'm very excited about seeing some of these other things come along, because I think they take the leverage out of the system, if you will, and give us more stable and economic growth.
Got it. So for someone, today, we don't necessarily all have the benefit of your experience, of the history. You have studied REITs for a long time. You see things differently. Where does the opportunity lie?
Well, oh boy. As I say, in today's REIT industry, I come at it from a stock perspective. You have to understand, I'm always looking for stocks. My colleagues laugh at me, but I want stocks that go up, okay? And that's the way it is. And I'm looking at the industry today, and we have a little over 24 of real estate investment trusts that are over $10 billion in equity market capitalization. That means they're probably about $15 billion worth of real estate assets at the minimum. Some of them are, knocking on $100 billion. And what I'm seeing is that it is just impossible to manage that many assets. And I know real estate assets need, tender loving care every day to take care of the tenants.
That's an understatement. Yes.
Need tender loving care to maintain the properties. Make sure the parking lots are swept out and cleaned up after a snowstorm or whatever happens. People are not going to rent space in a building that is, looks like it's unloved and neglected. So anyway, I see these spinoffs, and I sort of made an interesting study of the spinoffs. The spinoffs tend to be what I would think of as problematical or unloved and maybe even orphaned kind of assets. And let me just give you an illustration that is in the market right now. And,
okay.
You can sort of see what is happening. There's a very, very large healthcare REIT called HCP Inc. It used to be called Healthcare Properties. And so it has developed a great portfolio of hospitals and other kinds of healthcare assets, medical office buildings, et cetera, et cetera, et cetera. And it had one group of assets, about $5 billion worth of assets, whose growth was dragging it down. And the reasons it's dragging down are somewhat controversial, but I just take it as a question that this group of assets was dragging its growth down, and they were all skilled nursing facilities, what we would maybe in an earlier day called nursing homes, and the economics are not all that great. There's a great deal of federal and state regulatory pressure on skilled nursing facilities. The interesting thing is the number of nursing facilities has declined by about 2.5% over the last 10 years. It's probably the only property type that where the number of and so this group of nursing home facilities has a major master net lease to HCP. The net lease was signed a number of years ago. It was signed under conditions where 8, 9, 10% was probably the interest rate environment. On today, the interest rate environment is 2s and 3s and 4s, and so the net lease needs to be reworked. And so HCP is going to spin off this $5 billion group of assets in a company called Quality Care Properties, QCP, and that's probably going to happen before the end of the year. Now, your readers and listeners can go on the HCP website, and you can find, probably 225 or 30 pages of liberal SEC language that will tell you should never invest in it. But that's the way prospectuses are written. And I would think that the QCP assets are going to be spun off under a new management, a fellow named Mark Ordan, who has a lot of real estate experience and has built a team to manage unloved assets, if you will. And if the history is correct, with almost all spinoffs in the past 4 or 5 years, the market will just sell them off. The stock will come out at X, and it's going to be 15, 20% less than X in 3 months or 6 months. And at that time, I would say we start looking really carefully at QCP, because you've got unloved assets. The net lease is probably going to be redone in some way, and the new management is going to find ways to make that class of assets work. So I'm looking very carefully at the net lease or the spinoffs. There's almost nobody talking about spinoffs in today's world, and so that's my contribution to you, Jay.
I appreciate it. Now,
get your listeners out there and start digging in to the spinoff, because I think they're a very interesting group of assets in the real estate world. That the second one that you'd want to look at is Varnado Inc., which is basically a New York real estate office and retail owner. It's going to spin off all its Washington, D.C. assets. I mentioned Varnado again because they're doing this creative deal with We Work and We Live. And what those Washington, D.C. assets are going to look like sounds pretty interesting to me. That probably is not going to be it. I doubt that spinoff will get done before the end of the year. So it's a group of the spinoffs, to my way of thinking, represent a situation where you can look at it from all angles and get a lot of information out of the SEC filings, and then you can take your time and you don't have to rush in. It's not the kind of a thing where you got somebody standing over your head and saying, put your money down today, fella, or, it's going to go away. It's a very interesting class of assets.
Got it. Now, I know that for everyone who's been listening this far, they're intrigued by you. They want to know more. It's clear you know a lot, and it's clear you're willing to share it. So I guess my question is, what's going to be the best way for us to follow up with you, to get a copy of the book, to find out more about what you're doing?
Well, the copy of the book tells my story of how I, came from, a sort of a nothing to have, a modest kind of claim on fame. Not everybody is going to follow my days, but to come back to a question you asked, time. Nothing happens overnight. I ran my newsletter for 20 years. It's been 22 and a half years since I came down here from northern New Jersey, where I had lived. And my wife and I have made a great life down here. So for any entrepreneur out there, they've got to think in terms of, 1 year, 2 years, 3 years, 5 years. And the second thing is prep. I worked awfully hard when I was in college, and I worked awfully hard when I was in the newsletter or the newspaper business to understand what it took to make a success out of writing or investing. Put my own money on the line when I was investing in the 60s. So nothing happens overnight. I can't emphasize enough reading. I should mention reading. I have read, maybe 50 books on real estate and so forth. And I just feel that anybody out there with a library card can read and read and read. I call it public library university because I think that public libraries are maybe under a lot of pressure right now. But boy, oh boy, are they important.
Yeah, agreed. And so where can we get a copy of the book or find out more about what you're doing? Do you have a website or something?
Yeah, it's www.watchthatratHole.com. Yes, ring it up. The publisher is Archway Publishing, and you can buy it from Archway. And the list price is $45.95, something like that. It's 600 pages. Believe me, it's a lot of my friends call it two books in one. I'll call it two books. Figure it as two $23 books. If you can go on Amazon or Barnes and Noble. They have copies of it. At one point, I will say that my wife and I have been really, really, really supportive over the last 20 years or so of an organization that's in Philadelphia here that has until a couple of years ago provided 24/7 care to at-risk youth, primarily off the streets of the city of Philadelphia, but all up and down that Delaware Valley area. And so we've put all the royalties from this book go to the scholarship fund that we have set up, or that has been set up, of the BCS. And you can read that. You can read about that in the book too. We just feel that there's no reason for us to take any money out of the thing. We would rather give that money to the organization and provide scholarships. I watched the program the other night about on John Walsh, and he talked about slavery and where women would be essentially chained in captivity to become prostitutes. This happened to be in Houston, Texas, but it could be anywhere. And we have in our organization and in the network of homes that we run, we have 2 or 3 young women who've just had that same history. They got trapped into prostitution at the age of 12 or 13 and got out of them at 16 or 17. And now they have 1 or 2 children, and they are just so dedicated to get an education and to go on with their lives. And so we're just, I bleed with people to help support this kind of thing, because we're just not going to get anywhere in our society if we don't reach out to those people who've just gotten trapped in poverty and bad situations. And so anyway, that's the story of the thing. The University of Pennsylvania Libraries is digitizing all the Realty Trust Review, Realty Stock Reviews from 1970 through 1990. It's about 4,000 pages. It's going to be
Nice.
online in about a year. So that's another way that people can do it, to look at it. But gosh, Jay, I appreciate your letting me unburden my heart here a little bit on this, because I just think it's so important that we give people, young people, especially disadvantaged young people, been tramped on by really greedy people, to give them an opportunity to make a go. Entrepreneurship, I 100% believe it's got to happen, and if we can find ways to finance them through the crowdfunding route or free up their entrepreneurial juices, that's the way to go.
Agreed. So here's the final question, because there's a number of people listening, and I know because I get the emails and we talk in our consulting sessions, etc., that they're wanting to become an entrepreneur. They could be standing in front of right now, Ken, standing in front of the superhero outfit store, trying to pick up their outfit, thinking that they actually want to put their toe in the water. Maybe they want to run a magazine. Maybe they want to start a new business. Maybe they just want to do real estate. Whatever it is, they believe that they want to do it. However, they have this voice in the back of their head. And I know it's a voice you're familiar with. Sometimes we're related to that voice, and it's a voice that often tells us what we can't do, why it won't work, how dare we think to grab at something so great. My question to you is, what would you tell that person right now if you knew that they were going to actually do what you said, and if they were going to do it in the next 24 to 48 hours, what would you tell them to do?
When we had, I had been lucky in the stock market, take the grace of God and say it was just luck. And I wanted to start a business, and my wife said, put some money aside for 1 year so that I can put food on the table. My children at that age were like 14 through 8 or 9. And it was the toughest doggone decision that we've ever made, to leap out there and know that you were, you might go into bankruptcy. All sorts of bad things could happen. And so we did it what we thought was judiciously. We took, that little stake that we had, and we split it up, and we put enough aside so we could live and pay the mortgage. And it was tough. Jay, I just have to tell you, it was a tough decision. But I think we believed that in our, number one, our experience, and in our competency, and in the market. I guess if I had to think about it, those are the three things that I would think about it. And competency comes from your training, the things that you've done in your life. Experience is what you've done up until now. So anyway, we just have to trust in our own selves. There's a higher power out there, and he's going to tell us. There's going to be that little voice inside us that says this is good or this is bad. And so it was a calculated risk. In my instance, it paid off, but I will tell you that there are a lot of people out there that, fail. And I tell my friends, if you fail once, don't worry about it. Go back and do it the second time, the third time, because sooner or later, if you've got that entrepreneurial spirit, that soaring yearning to do something out there, something big with your life, you can do it. And just don't get intimidated by one failure. That's the way I would look at it, Jay. And that's what I tell my grandchildren, and that's what I tell my anybody that asks me the question, and that's what I would tell any reader of the book.
Awesome. Thank you very much for taking the time to just share your experience, your wisdom, and everything else that you've shared with us here today at the Cashflow Diary.
Jay, it's been a great pleasure, and I sure hope that we can get to shaky hands each other someday.
I haven't been to Philadelphia, but you know what? that there's nothing wrong with taking a plane and figuring it out. I'm sure we can.
That's right.
Awesome.
We'll see you around the track.
All right. All right, ladies and gentlemen, you know what time it is. It's time for you to move at the speed of instruction. What does that mean today? That means get over to watchthatrathole.com, because if you are anything like me, you know that studying history can often give you clues as to what might happen in the future. And most importantly, you might uncover something that no one else sees and be able to finally make your mark. It's been fun talking to you guys today. I look forward to talking to you soon. Until next time.